Very warm welcome. Welcome to HYCM's online trading workshop with myself, Giles Coughlin. Really looking forward to this session. Thank you all for able to joining me today. This is going to be an interesting webinar because we got it's the most interesting trading day of the week with the Bank of Canada and the Federal Reserve both meeting. This is from a monetary policy perspective. I was going to run through how the week's gone and just put everything in context, and then we'll get into how to trade the Fed and the BoC meeting. Don't forget to look at different entries, exits. This is all from a educational point of view, and any sort of trading ideas we'll look at a few of them. It's all from an educational perspective. I'll also show you a trade I took on the VIX yesterday. So the guts of our webinar is how to trade the Fed meeting and the Bank of Canada later today. So let me just put things in a bit of context for us all. I think that's right. Let's have a look. Yeah, there we go. Right. Okay, so let's first of all look at world indices. Now, we had that heavy sell-off on Monday on the Russian-Ukraine drama. The fears is that Russia's going to make a land grab or some kind of annexation on Ukraine, and that's got the US understandably upset, the Eurozone and NATO. So there's a potential for a military standoff, conflict. There's potential for significant economic sanctions being placed on Russia. All of that hurt risk sentiment. Now, if you take a look here, this is the VIX. Now, the VIX is essentially a fear index. And if you look all the way back, let's look at the monthly chart. See, all the way back to 1990s, like any time the VIX is like above 40, it signals crisis. So like 1999, that was the Asia crisis, 2001, 2002, dot-com crisis, 2008, global financial crisis, 2015, Eurozone crisis. We had 2019, 20, we've had Omicron crisis, right? All of that has seen the VIX over 40. Now, the VIX was pushing up towards 40, because obviously, if Russia did invade Ukraine, that would have been a significant crisis. Now, yesterday, I shorted the VIX at this sort of level around sort of 3,500 because there was a headline that came out that Russia was due to meet President Macron, according to the Kremlin, on Wednesday. So I thought, okay, well, look, if Putin is due to meet Macron on Wednesday, they're not going to invade Ukraine like today or tomorrow. It's just a de-escalation. So I just faded the VIX, and you can buy and sell the VIX. You see, one little technique you can use, and HYCM clients can trade the VIX, right, is all you do is as the VIX is moving higher, once you start to see signs that the market is turning, you just sell the VIX. Now notice, like every single time, if you'd sold the VIX from from the 1990s, looking for the VIX to move back to 20, it does, right? So you obviously have to watch out for rollover, and you have to watch out that where is the top. You might have sold the VIX there and thought, well, there's the top, So you just got to be careful that, price has turned. But once you can see that price has turned, and usually it's a sentiment shift, then you can fade the VIX. Now, yesterday, we saw more upside in stocks just because the Fed was meeting today. So stocks are taking their cue from the Fed. So I was able just to go long, and this is, I flagged this up to the financial, guys know I'm an analyst with Financial Source, and I flagged this up to the team there and to the subscribers. Just went long ahead of the FOMC as price moved back down to this support level on the Dow. I thought, well, actually, it's not like the stock's going to make fresh lows ahead of the Fed. Now, why are stocks moving lower? Well, NASDAQ is the poster boy for lower stocks at the moment because tech stocks are the most vulnerable to hiking interest rates from the Fed. So what's happened is because the Fed is hiking, as growth is slowing and inflation is slowing, that means conditions are less accommodative for companies, and companies which are already highly valued are concerned that they're not going to, investors are concerned that companies aren't going to be able to keep up the rate of returns, they are going to have a downturn in terms of their future profitability. So that's why we're seeing stocks dip. Now, what investors are worried about is this. See, back in 2018, right, we saw like a 20+% correction in stocks in the NASDAQ. Now, what it was then in 2018, sorry, let's get to the right. What it was in 2018 was that the Fed was hiking as growth was slowing, right? Now, it wasn't until prices have moved down about 20% from peak to trough that we've got a reaction from the Fed. So at the moment, this move lower is unlikely to be enough to move the Fed's hands, get them worried. So remember, as we look at the decision, the Fed's got to ask themselves this question: what am I most scared of? Is it causing a slowdown in equities and these recent falls in equity markets, or rising inflation? If they're more concerned about rising inflation, they're going to keep to their mandate or increase their interest rate hikes, and we'll go into it in detail in a minute. If they're more concerned about company valuations, then they'll slow down, right? And that's, you know, the rock and the hard place that the Fed are stuck between. Now, remember, they haven't hiked interest rates yet. We're just talking about ending QE mid-March at the moment, starting QT, and first rate hike expected March. Some analysts thinking they'll double up with a 50 basis point rate hike. So that's what the Fed's thinking. Now, these falls down to 1400, a lot of that was on fears about Russia, Ukraine. Now, one analyst I was reading on Bloomberg earlier in the week said that actually for there to be a 20% correction in stocks, that would take the S&P 500 down to about 3670. So just so you know, the received wisdom is that this is not enough to worry the Fed in terms of stock falls. Once again, you see key trend line break of the S&P 500 offering a very nice entry. This does mean that stocks, as long as the Fed is expected to hike, remain sell on rallies, right? So these key trend lines that are broken, if we have a retracement back up to them with US stocks, that's expected to be a rally that's faded. Notice the European stocks in a slightly different position. And European stocks are seen as better value than US stocks due to valuations. Right, that is just by way of introduction. And I hope that gets, you know, us up to speed where we're at in terms of stock markets. And of course, this impacted the risk trade in the week. So we saw oil prices move slightly lower, but then look, oil prices are very well supported at the moment because of very low inventory levels and the Russian-Ukraine crisis. If the Russian-Ukraine crisis goes ahead, right, and Russia do make an incursion to Ukraine, expect oil to spike up to like $100 plus a barrel, right? Also expect natural gas to spike higher. I'll tell you why, because Russia provides about 90%, Russia provides about 40% of Europe's natural gas, and a lot of it comes through Ukraine. So if there is an incursion, then expect natural gas prices to surge higher. Okay, that's an opportunity where you'd use a new squawk, and by using a new squawk, you would you would hear that headline as it breaks, and that's when traders would just jump into natural gas. As long as it's got that key trend line, you know, that could be used as a fine limit measure risk. So at the moment, that's, you know, that'd be only on an invasion. Copper prices pressured lower, but, and this is important, notice, do you see how China's stock market, hasn't had such bad falls? Well, that's because there's a difference in China than the rest of the world. The rest of the world are looking at hiking interest rates. China are looking at cutting interest rates. In fact, this week, the People's Bank of China cut interest rates by 10 basis points to 2.25 from 2.35%. There's fiscal stimulus expected in China's economy. So from a medium-term perspective, this looks great value for buying. And, you know, given the fact, you know, that look how on a daily chart, when you know, the Nasdaq, etc., was falling, 4% on the day. The China's A50 index fell 0.08%. Right. So the conditions for China was much better, with the PBOC looking at cutting interest rates. So risk can be defined below this trend line, below this support level. So stops can just be placed below 14,500, looking for a move back up to 16,700 as a first target. If that gets hit, back up to 18,400 as a second target. Yeah. Ultimately, if you're holding it for the longer term, you're looking for 2,000 and beyond. So that A50 index does look good value, and that's part of the reason for the difference. It's a lot to say, right? Okay. Without further ado, let's get stuck into the daily risk event outlook. Now, I'm using this from Financial Source Terminal. I am an analyst for Financial Source, and part of my daily work involves running through these key risk events. So the first key risk event for us to look through is the Bank of Canada policy meeting. Now, this is at 3 o'clock UK time. Couple of things to say. Right, I'm going to summarize this so it's nice and easy. The Bank of Canada, right, markets are pricing in 6, I said it again, 6 interest rate hikes this year for the Bank of Canada. That seems awfully aggressive. Now, the orange line is US inflation. See the headline? Inflation heading up, 7% headline inflation. Wow. The blue line is the average CPI reading of the trim, median, and common year on year for Canada. And yes, look, the inflation data is high, it's highest since 2000s, but it's not as worryingly high as it is in the US. So will the Bank of Canada be forced to hike interest rates in the way that markets are expecting? Okay, it's very unlikely that the Bank of Canada will be forced to hike interest rates in the way that the Bank of Canada is expecting. It's very unlikely that the Bank of Canada will be forced to hike interest rates at the same pace as the US, because inflation, it's high, but it's not at a control high. So that means the Bank of Canada may end up being on hold. Now remember, oil prices have been really high recently, and near term, you can see those gains carrying on because OPEC Plus, I just read a report today, they're quite happy at the moment to carry on their production increase. And that tells you that structurally they're happy with the price of oil and they're happy with the potential outlook for the price of oil. So oil prices are high, that supports the Canadian dollar. But is it enough for the Bank of Canada to start an aggressive rate hiking cycle and opting for 6 rate hikes this year? I think that's overcooked, right? So my inclination is that it's more likely for the Bank of Canada to be more dovish. Now, markets are placing a greater than 80% chance of a hike today, right? So that's the market expectations. My personal view is those market expectations are misplaced. So if the bank holds today, that will be enough to trigger CAD downside, okay? So if they hold interest rates, if they stress that even though inflation is higher than they thought, but underlying inflation is manageable, and if the growth outlook is still cloudy enough, they still want to leave the output gap expectations for the middle quarters of this year, if the bank does not drop language that says the economy still needs a considerable amount of accommodation. So in other words, if they have a more dovish tilt, look for Aussie CAD upside. Now, why Aussie CAD upside? That's because, I'll show you the pair. This is something I'm long. I'm going to decide whether I keep my long positions in. I was long from about 0.9012. I got in, a few days ago. Because everything has now been met for the Reserve Bank of Australia, right? At their last interest rate meeting, they said they needed 3 criteria. And if you just take a look here, I've got this on my blog. If you're not reading my blog, make sure you check it out each day, okay? Because I do put up lots of decent information up there. Let's just see. Yeah. So this is the 21st of January. Just put that in the chat box. Right, okay. So basically, there's a number of things supporting the Australian dollar. So first of all, like the three guiding principles of the Reserve Bank of Australia, right? One was unemployment. We've had two jobs prints in. Both of them are very good. The last jobs print showed 60,000 headline increase, 40,000 which are full-time, unemployment down to a 13-year low. Fantastic, right? Inflation has come out high. It came in at above the midway point at 2.6% year on year, above the midway point of the 2 to 3% range that the RBA targeted. So inflation tick, unemployment tick, commodities are higher. Iron ore and coal prices are both higher, right? Have a look here. Look, iron ore prices higher, coal prices higher, both supported for the Australian dollar. China, People's Bank of China cut interest rates, right? And if you just take a look here at the look at this. Let me just find the right chart. I will get there. There we go. Right, look at this, and you see this is China's 50 index in the red. This is a basket of the Australian dollar in the blue. Do you see how the Australian dollar tracks China's economy? China's economy had a bad year last year, right? Now China's economy is looking like picking up with BoC easing. So that should be supporting for the Australian dollar. We also have the fact that the RBA said they would have to look at what other central banks were saying. And not only and look how hawkish the Fed has turned. They also said they'd be looking at the bonds market. Now, if you look at Australian 10-year bonds, like bonds around the world, you can see, look, they've been surging higher. And this is a 2-year bond. Now, on the yield curve, the earlier bond yields, like the 2-year yields, when they start moving higher, that's indicative of interest rate changes, right? So you can see here that the 2 years have been spiking higher recently. You just go down to the 1-hour chart. You'll see that's the spike high 14th, spike higher with the Australian CPI data coming up, right? So everything's kind of in play for the RBA to turn more hawkish. So should the Bank of Canada be more dovish today, Aussie CAD longs make sense. You see, and you're looking for a move, back up to that swing point 0.9250. So that's how to trade. That's how I'm looking to trade the Bank of Canada. The best opportunity is in a more dovish outlook. If they are more hawkish, then looking at something like a New Zealand dollar CAD short would make sense. So if they start to say, look, the output gap has been closed, we deliver a hike, but if it was struck, so a hike is not hawkish. It's only if they deliver a hike plus aggressive forward guidance that would be hawkish. Okay. My best opportunity is here, Aussie CAD, because that's against what the market's expectations are. Now, looking for the FOMC policy decision. Now, the trouble the Fed have is this. Look, do you see how ISM PMIs, non-manufacturing survey index, the Empire State Manufacturing Survey, retail sales, all of that's been pointing down recently. There's been a slowdown in growth. And this is the big problem the Fed has. If they hike rates, they're hiking when growth is slowing down. Ideally, you want to hike rates when growth is still sort of ticking a little bit higher. You want to be controlling growth, controlling inflation. You don't want to hike as inflation's falling, right? It doesn't make sense. But the Fed are stuck because inflation is such high levels. They have to be seen to be act. It's very politicized in the US, inflation. You can understand. Anyone under the age of 40 doesn't really understand what. Well, I say I'm exaggerating, but anyone under the age of 40 hasn't necessarily experienced high inflation, particularly not here in the UK or in Europe or in the US. Some other countries would have experienced high inflation, but most people in those countries under the age of 40 haven't experienced high inflation. So when they've got a mortgage, you know, they're paying 1.5%, 2.5% in their interest rate. They look at their interest rate payments, great. They have no idea what a 10, 12%, 14% mortgage would look like, and it's not pretty. So the Fed obviously know only too well that the problem of higher inflation, and so do some wiser older heads in the West, particularly, have seen those high inflations. I remember my parents paying 16, 70% levels on their mortgage rate in the 80s, and that was, you know, a big struggle for them. So the Fed don't want to see inflation get out of control, but if they slow growth too quickly, you see the problem, right? So this is what we're going to look for. If they're hawkish, if they surprise and they say early end to quantitative easing, so rather than allowing tapering to end mid-March, they end it sooner. If they start to say we're going to tighten sooner, we'll start QT, say in March or even sooner. If they acknowledge that the previous Fed projections of 3 hikes is too tame, if they give a clear signal that QT will start earlier, potentially as early as March, and if the Fed is asked about recent equity market reactions, so they're more concerned about inflation, this is the key thing. If they say we're more worried about inflation than equity market moves, if they say that, in line with these actions, then you expect a strong US dollar CAD upside, particularly if the BoC disappoints, okay? Also, the other reaction is you'd expect significant downside in gold and silver, okay? Gold and silver would also fall. Now, whenever you're trading gold and silver, a mistake that people make is they think, oh, gold and silver, it's just correlated to like the dollar. So, you know, if dollars up, gold's down, gold's up. It's not that simple. When you're trading gold, the chart you want to have a look, you want to be looking at is you want to look at these three. You want real yields and you want to see the dollar. Right, now what you're looking for, I'll try and show you an easier chart, right? You see here, I'm going to take silver off. Right. You see when this is the tips. So this on TradingView, you can get this symbol. Just take a screenshot here as tip. This is a proxy for real yields, right? And this is updated intraday. The tip. When you see real yields falling, the blue, and the dollar falling together, that's when gold rises. If we saw a hawkish Fed, we'll see the dollar rise back up to that 97. We should also see real yields rise. Now, real yields, it's just a nominal bond yield minus inflation expectations. When you get these two together, right? When you get these two moving together, that's when you get the best reaction in gold. So notice, real yields dollar falling, gold soaring. Real yields dollar falling, gold soaring. Real yields dollar rising, gold falling. Real yields dollar rising, gold falling. At the moment, we've had a disconnect. Real yields falling, real yields rising, dollar falling. Right? That's a mixed message. We want these two together. So make sure you get the two together. If we see a hawkish Fed, we should see the two together. If you're unsure, keep an eye on bond yields. You want to see 10-year bond yields moving lower, and you want to be making sure that they're moving lower more quickly than inflation expectations. But that's what to look for if we see a very hawkish Fed. Now, if we see a dovish Fed, then that's the opposite. That will be gold upside. That will be Aussie US dollar upside. Looks very attractive, okay? So what we're looking for there, Fed pushing back against market expectations of 4 hikes. Say that, you know, okay, we're going to be data dependent maybe, or we might slow down. They push back about the calls for an early end of QE. They push back against a 50 basis points hike. They say the aim is not to fabricate a growth shock, but to slowly ease the economy away from ultra easy accommodation. If they sort of play for time, they want to slow down. If they say they take notice of the recent slowdown in forward-looking growth data, and we're getting a bit cautious, we're watching out for the speed of this deterioration, we're ready to support the markets, anything like that, Aussie US dollar makes sense. And you also expect something like gold upside as well. Folks, there we go. You're all ready, okay? That is the things to be looking at. They're the key currency pairs in play. And obviously, if you see a dovish response, you'd also expect upside in stocks. Okay, folks? Right. I hope that is okay for everyone. I'm taking silence as good news. Don't forget, be back here on Monday to get ready for the coming week. And next week, got the Bank of England meeting. So looking forward to getting into that. And yeah, good, Max. Excellent. Thank you very much. Let me know how it goes. Okay. I hope everyone does well. And 3 o'clock UK time, BoC meeting, 7 o'clock Federal Reserve meeting. They're good ones and wants to be on. I hope everyone has a great day and look forward to seeing folks on Monday. Take care, everyone now. Goodbye.